And now introducing Mr. Keith Lanton.
Good morning. Welcome to Monday, October 17th. A little past halfway through month of October, making our way towards midterm elections and halfway through the second month of what sometimes is the most challenging time of the year for the U.S. equity market, and that's the September-October period. So perhaps getting towards some change or inflection point, as at least the calendar indicates we are moving to a different phase of the year at the very least. This morning we're going to focus on investing for the long term, to keep our eye on our goals and our objectives, the importance of patience when investing. Many times when things aren't going as we'd like them to, we think that we need to take action, and this often leads to frenetic activity, whether it's within our portfolios or our personal lives. And we'll talk about a book called Richer, Wiser, Happier. This is a book by William Green, where he talks about some of the greatest investors and how they win in the markets, and how they carry that philosophy over to their lives. And it's a great time to hit on these themes, as there are lots of opportunities in financial markets with all the upheaval, both in equity markets and bond markets, commodity markets. So finding the right spots and having the conviction and having, most importantly, the patience to see through your convictions is often the keys to success. And as you go about having that mindset, have it alongside or in conjunction in synchronization with your goals. So here we are at the end of 2022, in the middle of the fourth quarter. This is the time to start thinking about 2023. And what do you have upcoming for 2023? What do you expect to be the same? What do you expect to be different? How do you need to position yourself financially? Now is the time to think about that, so you can start making the appropriate steps or changes that may or may not be, and the key here is may not, and the key is also may be necessary for you personally in 2022, going into 2023, because the landscape is changing. There are opportunities both to manage your tax portfolio with tax loss selling, as well as opportunities to reposition your portfolio for the long term. So this morning I will talk about the book I just discussed. I'll also talk about some of the recent commentary from Fed governors that Sal Favarolo had sent over to me. We'll talk about the news this morning, what we have coming up this week. Lots of earnings. Already got earnings this morning from Bank of America. Came in a little bit better than expected. And then we'll talk about Barron's. They had a big money poll, and we will hear what professional investors are thinking about the state of the world economies. And I'll talk a little bit about the bond market, so I will do my best to cover some of the topics. So, Richer, Wiser, Happier, how the world's greatest investors win in markets and life. I'll give you some feedback from this book. One of the investors that was profiled was Peter Lynch. He was the famed manager of the Fidelity Magellan Fund in the 80s and 90s that significantly outperformed financial markets, and still respected and renowned in the financial industry. What he said is that to be a great investor, you need to have a lot of humility. Because financial markets, as we know all too well, are extremely volatile and unpredictable, and many of us have the life experience of getting measured of how successful we are by going to school and getting our grades. And the good news is that if you study hard, there's a very high likelihood that you will get A's and B's in school, maybe an occasional C, but you rarely get an F. And for those who work hard and are not used to getting Fs, the unfortunate fact is that in the world of investing, you will get Fs. And out of, let's say, 10 attempts to purchase equities, if you're getting 6 or 7 A's and you're getting 1 or 2 Fs, you're doing really well. You're doing a really good job. and you have to maintain that mindset and not try and overthink and overdo and overtrade, because with winners, unfortunately, you will also come across some losers. So what he says is there's no certainty, and it's all about the probabilities. And he goes on to say that one of the great sources of his education in terms of managing and measuring probabilities in a very rapid environment had to do with playing games of chance, like poker or bridge or anything that you engage in that you're constantly recalculating the probabilities will serve you well when it comes to thinking about how to invest, because you're trying to skew the odds in your favor. It doesn't mean it's always going to go the way that you like it to go. He goes on to say, as I've come to realize, it's helpful to view investing and life as games in which we must consciously and consistently seek to maximize our odds of success. One critical way to improve our financial lives is to avoid games in which the odds are stacked against us. And Jeffrey Gundlach, well-known fixed income investor, has said, hope is not a method. Another investor, James Thorpe, went on to say that he approaches investing as a situation in which he tries to maximize his odds, both his odds of having a happy and successful life and his odds of investing successfully. And he uses an illustration whereby he compares it to what he does in terms of his health and fitness. And if you think about health and fitness, genetically, you're dealt certain cards. You can think of that as chance, but you have choices about how to play those cards, including the choice to avoid cigarettes, have annual medical checkup, keep your vaccinations up to date, and exercise regularly. So with that thought, and the thought of changing our possibilities by thinking about our probabilities, we will go on to talk about how we can think about that more in the details. That's the macro thought, and we'll talk here a little bit more about the micro and the financial markets. Next week, we'll talk some more about another investor in the book Richer, Wiser, Happier, and that investor is Monish Pabrai, who is a disciple of Warren Buffett, and we will go into his thoughts next week. But this morning, taking a look here at financial markets, we will take a dive here after the sell-off on Friday. And this morning we are getting a modest recovery where we're seeing Dow futures trading about 275 or about 1% over fair value. S&P futures right now are up about 40 points, also about 1% above fair value. These are levels are off their best levels of the morning. One that is clinging on to its best levels of the morning is the NASDAQ futures, which are up about 156 points or 1.5% above fair value. U.S. equity futures have a positive disposition this morning after the new UK Finance Minister, Jeremy Hunt, announced a reversal of almost all the tax measures in the prior quote-unquote mini-budget. Mr. Hunt added that this will raise about 32 billion British pounds. The announcement has calmed the currency and UK gilt markets. That's the UK bond market. The 10-year UK gilt yield is down 48 basis points to 391. Obviously, that's a whopping drop in rates in the UK, and points to the extreme volatility in the bond market, which is supposed to be a much more tame market in terms of how it trades. U.S. dollar index is down about 0.3%. The British pound is up about 1%. It's about 1.13 British pounds to the dollar. The other way around, it's about $1.13 for every British pound. The two-year note yield is down 5 basis points to 4.45. The 10-year note is down 6 basis points to 3.95. Morgan Stanley chief strategist Wilson said in a note over the weekend that there's a good opportunity that the S&P 500 may have a sizable technical rally, assuming there are no major earnings disappointments or that there is a recession. China had their 5-year meeting of their Politburo. At this event, President Xi was reaffirmed to remain as the leader of China, and he also reaffirmed their zero coronavirus policy. Some were expecting or anticipating there might be some easing with respect to that policy. That did not happen. He also said he is aiming to achieve a peaceful unification with Taiwan, but won't rule out the use of force. Speaking about the markets in Asia, overnight, we saw the Hang Seng up modestly, up 0.2%. The Chinese markets up 0.4%. The Nikkei dropped 1.2%. As Japan's industrial production actually came in slightly higher than expected, but the currency in Japan remains weak, and there are concerns that the Japanese economy is slowing even more than previously thought. There was also intervention by the People's Bank of China in the currency markets as they were selling dollars to boost the Chinese currency. Major markets in Europe trading in the green, up about 1% on average. The Spanish market up the greatest amount, up 1.7% in Spain. New York Times is reporting that Russia used Iranian drones to attack Kyiv, and some talk this morning that if it can be proven that the Russians are using Iranian weapons and that the Iranians are helping the Russians, that there may be some consequences from the Europeans and the U.S. Toward Iran for their participation. President Biden, CNN saying that he does not plan changes to Saudi relations until Congress returns from recess. Options include re-examining arms sales to the kingdom in Saudi Arabia. Companies in the news, Morgan Stanley named Apple its top pick in the event of an economic downturn. I mentioned Bank of America. They beat by 3 cents. They beat on revenues. The stock is up about 93 cents this morning, or about 3%. BNY Mellon, symbol Boy King, BK, up about 4% this morning. They beat by 13 cents on earnings, and they also beat on revenues. Goldman Sachs this morning up about 1.5%, or 4.5 points. Wall Street Journal reporting that Goldman is aiming to combine its investment banking and trading units. Speaking of some commentary and some events that we have to look forward to this week. First off, earnings today. Also seeing earnings from Charles Schwab on top of the Bank of America and BNY reports. And then this week we get a slew of earnings. Tomorrow, companies like Netflix, Lockheed Martin, Johnson & Johnson, Goldman Sachs. Also tomorrow on Tuesday, we get industrial production data for September, looking for that number to be unchanged. On Wednesday, earnings from IBM, Tesla, Procter & Gamble, Nestle, NASDAQ, Lam Research, Alcoa. Wednesday, the Beige Book is released by the Federal Reserve Bank, giving us current economic conditions among the 12 Federal Reserve districts. Friday, earnings from Blackstone, Next Era Energy, AT&T, Quest Diagnostics, CSX, the rail company. Also on Thursday, the Conference Board is releasing its leading economic indicators for September. The consensus estimate is for a seasonally adjusted decline of 0.3%. Also on Thursday, the National Association of Realtors reports existing home sales for September. Friday, earnings from American Express, Whirlpool, and Schlumberger. Markets have been significantly affected, obviously, by the policies of the Federal Reserve. Markets starting to strongly accept that the Federal Reserve is going to be very aggressive in terms of quelling inflation and keeping rates higher for longer. On that score, I'll share with you some commentary from various Fed governors, and what I think you may conclude is that there is unanimity now among Fed governors in terms of their message, and the market's starting to hear that message and get that message loud and clear. This week, on Tuesday, Atlanta Fed President Bostic is going to be speaking, and he spoke on October 5th, and at that point he said, "I am not advocating a quick turn toward accommodation. On the contrary, you no doubt are aware of considerable speculation already that the Fed could begin lowering rates in 2023 if economic activity slows and the rate of inflation starts to fall. I would say not so fast." We also get commentary on Tuesday from Minneapolis Fed President Kashkari. He said as recently as October 12th that if we thought that inflation was headed back down very, very quickly, the Fed would reverse course. Then he went on to say, "For me, the bar for such a change is very high because we have not yet seen much evidence that the underlying inflation is yet softening." Wednesday, we get commentary from Fed President Evans. He said on October 10th, we're headed for this 4.5% federal funds rate by March. That's March of next year. We are going to put a lot of restrictiveness in place no matter what the data comes in at, unless there was really a lot in the next 2 months to indicate otherwise. And he said there's really not enough time for that to actually happen. He went on to say, ultimately, inflation is the most important thing to get under control. It's job number one. If unemployment goes up, that's unfortunate. If it goes up a lot, that's really very difficult. But price stability makes the future better. St. Louis Fed President is also speaking on Wednesday, and he said it makes sense that we're still moving very quickly. He said that on October 14th. To drive the point home, on Thursday, Fed Governor Brown speaks. He spoke on October 12th, and he said, "Inflation is much too high, and I strongly believe that bringing down inflation back to our target is a necessary condition. If we do not see signs that inflation is moving down, my view continues to be that sizable increases in the target rate for the Fed funds rate should remain on the table. To bring inflation down in a consistent and lasting way, the federal funds rate will need to move up to a restrictive level and remain there for some time." So, lots of Fed commentary coming this week. Over the past 2 weeks, you can see the Fed commentary very consistent about a very clear path forward to be pretty tight with monetary policy, to some would say very tight with monetary policy. Markets getting the message loud and clear. And the good news, perhaps, is that the market is now on the same page as the Fed. They feel that the Fed is very serious about fighting inflation. They've priced a lot of that now into the equity markets, as we've seen the magnitude of the price declines. And now the question becomes, how much of the bad news is priced into the market, and how close are we to getting at or near a market bottom in terms of equity rates, and how at or near are we to a peak in interest rates? So on that score, last week, investors were trying to once again pick the bottom of the markets. We had a topsy-turvy week, and investors on Thursday thought that they had picked the market bottom. We saw a big reversal last week, where we had markets dip significantly on Thursday, down 2.6%, and then we had a 2.4% recovery, a 5% swing, and then on Friday we saw markets drop again, and now this morning we have futures up almost 300 points. But Barron's goes on to say, still for the first time in a while, it feels like there's hope. Part of that is simply the market starting to acknowledge that the Federal Reserve will do what it said it would do, crank up rates as high as they need to go to tame inflation. We just heard that from all that commentary from all those different Fed speakers. There's now more than a 70% chance the Fed raises rates over 4.5% by December, which would have been unthinkable just a few months ago. But the market is starting to act the way it does at lows. We talked about that big swing in the markets on Thursday. Bespoke Investment saying that we've had a move of that magnitude up and down only 9 times since 1983. And when those moves have happened to the magnitude that we saw in those 9 different times, the market the following 3 months was down 3.5%. But over the next 12 months, the markets were up 14.6%. So we're not sure when or where the ultimate bottom in stocks will end up. but violent moves like Thursdays tend to occur closer to lows than highs. Now, speaking about that, we talked about the importance of patience in investing at the start of the call. One of the commentators in Barron's at the Luthold Group, Doug Ramsey, went on to say patience is advised, but this long-term oversold condition should help some investors pull the trigger when they feel the time is right. Now, speaking about the timing and what we have to look forward to in the financial markets, Barron's shared with us their big money poll with professional investors. This poll is conducted twice a year, and here is their general outlook going forward. The good news is that if you look at bullish professionals and you look at bearish professionals, the bearish professionals aren't very far off from where financial markets are today in terms of where they think that the markets will be at the end of next year and in the middle of next year. So the bearish analysts, when looking at the S&P 500, the average there is that the S&P will be at 3,300, and by year-end the S&P would be 3,500. Right now the S&P is about 3,600. So not looking for the world to collapse, even on the bearish side. The bullish advisors are looking for the S&P 500 to be at 4,200 by middle of next year, and to be at almost 4,500 by year-end next year in terms of the outlook for the professionals. In terms of bullishness and bearishness as a group, the percentage of professionals that's bullish over the next 12 months is 40%, and we're looking at 30% that are bearish and 30% that are neutral. When asked the question, has the S&P 500 bottomed in the current bear market, only 16% said yes, 84% said no. Interestingly, when asked what is the biggest risk that the stock market will face in the next 6 months, number 1 was rising interest rates, number 2 was recession, number 3 was disappointing corporate profits. Numbers 5 and 6, way down on the list, were inflation and geopolitical turmoil. Which asset class do you consider most attractive today? The number 1 answer was equities at 42%, followed by cash at 22% of the professionals, and 14% said fixed income. When asked where they would invest their equity dollars, which market will perform best in the world, 62%, so the overwhelming majority, said the United States. A distant second was emerging markets, with 13% suggesting to look there. When speaking specifically about bonds, which fixed income category do you currently favor most? U.S. Treasuries, something we haven't heard in some time. The number 1 favored fixed income category, 39%. Favoring U.S. Treasuries. Number 2 was corporate bonds at 20%. Number 3 was municipals at 15% there. When talking about their expectations for the 2 and 10-year note 1 year from now, the greatest percentage of respondents when looking at the 2-year note came in with a expectation that the 2-year note 1 year from now would be at 3.5%, and the 10-year note would be 3.75%. Looking for rates to moderate somewhat, although I will give the caveat that these expectations were all over the board. Some expecting rates as low as 2%, a very small percentage, and a slightly bigger percentage expecting 2 and 10-year rates to exceed 5%. So that 3.5% to 4% range, kind of where we are now, is where the majority were expecting rates to still be a year from now. In terms of the terminal rate or the peak Fed funds rate, hearing a lot about that as the Fed is possibly getting closer to the top of their rate hiking cycle and where they may pause. Where that terminal rate is, 32%, which was the greatest percentage, suggested that the terminal rate's at 4.5%. Keep in mind we're at 3.25% now on the Fed funds rate. widely expected that we'll get a 75 basis point increase at the next meeting to take that terminal rate or that Fed funds rate up to 4. So 32% expecting the Fed to stop when they get to 4.5% on that rate. About 10% of the folks expecting that rate to actually climb over 5%. Couple of individual stocks mentioned in Barron's. Barron's wrote a profile on Deckers Outdoor. The symbol here is DECK, D-E-C-K. Deckers Outdoors may be best known as the maker of winter favorite UGG sheepskin boots, but the company, Barron says, has become a stock for all seasons. DECK has evolved beyond the UGG brand, which went from being super trendy to a more stable cash cow, with its rapidly growing Hoka line of highly cushioned running shoes. This sneaker, which has become very popular here in New York and the tri-state area, is something that some analysts said is a new level of growth that could make Deckers a long-term winner no matter what happens later. Deckers right now is changing hands at about 16.5 forward earnings. That compares with about 18.6% over the past 5 years, and trading at a lower multiple than Lululemon and Nike, which are trading at 18 and 25 times forward earnings projections. And that's Deckers Outdoor, D-E-C-K. Also, Barron's in the tech trader column spoke favorably once again about Oracle, symbol O-R-C-L. The column headline is Oracle stock looks cheap again. CEO Safra Katz has a plan. Barron's profiled Oracle favorably in February of 2021. And that looked like a prescient call at the time. The stock was trading at around 65, and it ran up to almost 100. And now the stock is back in the low 60s, and Barron's suggesting investors have an opportunity to take another bite at the apple. The thesis here is that Oracle is using the cloud to drive new growth in the company's application and data software business, while also moving to take on the big three giants, Amazon, Microsoft, and Alphabet, in the public cloud. They say that Oracle is getting traction on all fronts, and it's driving growth rates the company hasn't seen in more than a decade. Ahead of the company's Cloud World customer event in Las Vegas, which took place last week, the CEO, Safra Katz, agreed to an interview with Barron's. She talked about the Cerner deal. Oracle acquired Cerner, which is a company that categorizes and stores and analyzes healthcare data. It's one of the leading software providers in many of the nation's hospitals, and they help discern issues with patients, and they track medical history, medications, dosage. And this is an acquisition that the markets did not like. CEO Katz went on to say that the markets hated the acquisition, but she feels that it's largely misunderstood, and that they're going to pay for the acquisition, which was about $30 billion, out of their free cash flow over the next 2 years, and then they will outright own Cerner. And they view the medical space as a tremendous opportunity for growth and for integration within Oracle's applications over the next decade. She also talked about integrating Cerner into the cloud, and Oracle, has a new generation of their cloud-based application. It's called OCI Gen 2. She went on to say it's better, cheaper, and more secure than their competitors' cloud offerings. She said what they did in order to roll out OCI Gen 2 is they went out and they hired many of the first-generation workers from the cloud build-out experience at Microsoft and at Amazon, and they said to them, if you knew then what you know now, what would you build? And we built something architecturally totally different, she said. Customers who compare us with other clouds are often stunned, she went on to say. She said that auto companies like Toyota, Nissan, and Mazda are all doing their high-performance work in the Oracle cloud. Oracle has been buying back their stock, so much so that Larry Ellison now owns more than 42% of the company. As the company has been buying back stock, Larry Ellison hasn't been selling, so his ownership stake has been increasing. Moving on to a quick commentary on the bond market this morning. We are seeing yields drop even more sharply than I had mentioned earlier, pretty much across the board. The 2-year yield is down almost 10 basis points to a 4.40. The 10-year is down 9 basis points to a 3.91. And the 30-year is down 5 basis points to a 3.92. So you can see if you're looking at the 10-year at a 3.91, we're getting awfully close to a inverted yield curve, even when you look at the 3-month versus the 10-year. The 3-month is a 3.72. The 10-year is a 3.91. So if this trend continues, it's very possible or probable that when the Fed meets in the beginning of November, raises the Fed funds rate, if they were to do what's widely expected and raise that Fed funds rate to 4%, if that 10-year doesn't move up meaningfully, we could be at a inversion between the 3-month and the 10-year, which is a significant indicator or leading indicator of possible future recession. So probably hear lots more about that over the next few weeks if that were to occur in the next few weeks. One other scenario to keep an eye on in terms of interest rates, one factor that may have an influence on stimulating the economy at a time when the Federal Reserve is trying to slow the economy is that many states which received significant funding during the pandemic and received billions of dollars, as you may remember, many of the states didn't immediately spend that money as they went through the legislative process and trying to determine the best way to allocate those funds and to make sure that they were spending those funds in accordance with the terms that they received them on. And now many states are starting to spend that money as the rules have become clearer. And this is something that potentially could stoke inflation. 20 states have recently enacted or are in the process of enacting stimulus programs. These plans cover more than half of the U.S. population and in aggregate currently total about $31 billion. As inflation continues to rage, if these stimulus payments were to accelerate, it's possible that this could be a further source of concern for the Fed and may encourage the Fed to keep rates elevated for longer as this lag effect of some of this COVID stimulus spending starts to work its way into the economy. So just another factor to put into your crystal ball as you seek to think about what the world will look like in the next 6 and 12 months, and how to evaluate what that may mean for your overall portfolio, both your fixed income portion and your equity portion. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. This podcast is available on most platforms, including Apple Podcasts, Spotify, and Pandora. For more information, please visit our website at www.heroldlantern.com.
Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.